there, welcome back to Business 163 Personal Finance. This is our 7th and last video in our series on investing. And as you know from the title already, we're talking about different types of funds that we might use as vehicles for investment. And really, in order to explain this idea of different types of funds, you needed the last two videos on stocks and on bonds. The components that go into typical mutual funds and index funds to understand what really is the underlying concept of owning a stock or buying a bond, and then realizing that, of course, as we went through in each of those videos, that because you're talking about an individual stock or an individual bond, there's no diversification there. And of course, we've already talked about in the second video, right, the very important concept of investment diversification to guard against risk, right? So now you can put all these pieces together, so to speak, in this discussion in this video, which I'll warn you right up front, this is probably going to be the longest video of all 7 in this particular module, right? So buckle your seatbelts, and we're going to talk about investing in funds. And when we say funds, we're talking about things like mutual funds, indexed funds, exchange traded funds. What do those mean? What are those categories, and how should we understand these things? All right, so first of all, what is a mutual fund? We'll start there. What's a mutual fund? Well, a mutual fund is a fund that has the word mutual in front of it. So what does that mean? Well, the word mutual actually defines the whole thing, because it means it's a pool of money that mutually is pulled together, collected from many different investors in order to invest in a bundle of securities, right? So you can see the illustration there of a bunch of people all putting their money into a single box so that whoever manages that box has sufficient money to buy, well, a whole bundle, a whole different variety of different types of securities. The whole idea here is that a mutual fund collects investment money from a bunch of different investors, so they have a very large amount of money to wield, so that then professional managers, professional fund managers, can buy a bundle of securities. And typically, every mutual fund will have a particular unique strategy and a set of investment goals that they're looking to achieve when they select certain securities to purchase. What are some example strategies? Well, let's see if we can give you an actual excerpt from a mutual fund prospectus to show you what we're talking about. Here's an example. An example from a particular prospectus. You can read it here. Let me just read it to you because the fine print, the print's pretty small here. The principal investment strategies of this particular fund. The fund invests primarily in equity securities, that means stock, of foreign and domestic companies, okay, so they're international, right, that the advisor, the fund manager, believes are undervalued. So just stop at that first sentence, right? It means that they are looking for stocks of companies that they believe are lower than what the fair price should be. And so the stock represents a value because the price is under the real value of the company. And that, of course, means that the advisor is doing an enormous amount of homework, right, to identify a company, what's a real company's value, and wait a minute, the current stock price is under what I think should be the real value of the company, right? So the equity securities, second sentence, equity securities that the fund will principally invest in are common stocks, preferred stocks, and exchange-traded funds that invest primarily in equity securities. Under normal circumstances, the fund will invest at least 80% of its assets, plus the amount of borrowing for investment purposes, if any, in equity securities of small capitalization companies. Okay, here's another piece of the puzzle. So this fund is looking for undervalued companies that are generally smaller companies, not big ones, not huge ones like, I don't know, AT&T and Bank America. No, they're looking for small companies that are presently undervalued. All right, so that gives you an example then of a stated strategy and a stated goal that they're trying to accomplish with their fund. So that tells you then When we look at the characteristics of mutual funds have a focused strategy. They state it right in the prospectus. And different mutual funds will have, well, significantly different strategies than others. Your job then as an investor is to find a fund with a strategy that agrees with what you're trying to accomplish, right? Different investors will have different goals. And so you want to find a mutual fund that provides a vehicle to accomplish your unique personal goals. Now, some other characteristics of mutual funds we should point out. Remember that a mutual fund is a bundle of different securities, and therefore its price ends up being calculated when every day you end up figuring the new price of the mutual fund at the end of the trading day, after you are able to then calculate what is the actual ending price of the underlying securities that I have in this bundle in my basket. So the price of mutual funds don't change throughout the day like a stock does. It changes only at the end of the market day. Now, it also means when you purchase a share of a mutual fund, you are purchasing it from the fund. So you can only purchase it at the end of the trading day when that day's price is established. And when you sell it back, if you want to cash out, you're actually selling your shares back to the fund, not to some other individual buyer, right? In other words, the only way you can buy shares is from the fund, and when you sell it back to the fund, not to some other individual buyer. That becomes important in terms of the timing of transactions, all right? So now you understand a little bit of the basics of how mutual funds work. What are the advantages of mutual funds? Well, the automatic built-in advantage of a mutual fund is diversification, right? They are investing in a whole bundle of different securities, maybe some stocks, maybe some bonds, maybe both, right? And that means that you don't have to bear the burden of researching every single stock and every single bond that might be a wise investment. Professional management has done that for you. And so you achieve diversifying your investment portfolio without having to do all the hard work yourself. On a regular basis, it also means the portfolio is adjusted over time by people with far more experience than you, who are able to recognize, hey, maybe it's a good idea for us to get out of this stock and buy this other company's stock instead, because that will, over time, better help us to accomplish our stated strategy and goal. Now, stepping back, there's an enormous number of different mutual funds out there, which means that for you as an investor, you have a large variety of different options. There is virtually a fund for every type of investor out there. And it's relatively easy to understand just by reading the prospectus. What is this fund? How does it work? What's its strategy? What's its goal? Right? All of that is relatively easy to find. And so for most investors, they find investing in mutual funds, well, sort of easy to make choices. It's easier to read those things and understand, at least in general terms, what this fund is trying to accomplish and how it's going to do that. Well, nothing is perfect. What are the disadvantages of mutual funds? Well, realize immediately what you're doing is you're giving up personal control of your investment portfolio, right? You're handing it off to some professional manager to make those decisions for you. And these come with costs. Mutual funds have management costs because those professional managers don't do all that research for free. The costs, in some cases, can be relatively high. And remember, the cost they're charging you erodes your actual investment return. Well, that's not the only downside of mutual funds, the fact that you've got to pay some costs. Every time that a fund manager sells some holdings in order to buy something different, right, to adjust the portfolio, you as the investor realize a capital gain. Whether or not you actually cash out or not, you're being charged for a capital gain, which you have to declare on your taxes. So there are tax events that happen every time the fund manager adjusts the portfolio. And that's shared by all of the investors, whether you want it or not. So that's another underlying cost of owning a mutual fund. Every tax year, you have to report some capital gains just because the fund manager was rebalancing and adjusting the inner workings of the mutual fund. Well, here's where it gets really interesting, this fourth bullet point. Do you realize that no matter how the mutual fund performs, the fund manager's still getting paid, still collecting management fees? Even if you're losing money because the fund is underperforming the market, fund manager's still making a healthy living, right? And so you're still having to pay management fees whether or not the fund is performing to the way you want it to perform or not. And quite frankly, not most mutual funds underperform the market. What? These are professionals who are getting paid a good living. And still the choices they make with a strategy and goals, quite frankly, I think the number is 91% of mutual funds underperform the broader market. Wow. That should be a sobering thought, right? Yes, your portfolio is automatically diversified and therefore it mitigates investment risk. That's a wonderful thing. The rebalancing is all handled by a professional. But wait a minute. In terms of returns, mutual funds underperform the broader stock market. So, mutual funds have their advantages as well as their disadvantages. All right, so that's one type of vehicle. Take a look at this. This illustration I'm showing you shows the impact of mutual fund management fees, which are termed expense ratio, right? Growing at a 6% return for 30 years. Let's say that you are realizing a 6% return, but you are paying a certain amount of fees for your investment portfolio. If you stuck $1,000 in your mutual fund, look what happens, right? If you are only being charged a 1% expense ratio, that $1,000 will grow to $4,000 over 30 years. But if the mutual fund you picked has a 2.5% expense ratio, oh my goodness, look at that. Over 30 years, your $1,000 only grew to $2,800. That's the impact of the expense ratio, the fees that are charged for owning a mutual fund. And so as a result, many folks have said, man, I'm not so sure this mutual fund thing, the benefit of diversification, or should I say actively managed diversification, is really worth it. It's really eating into my investment return. And this is where we then come to the topic of our second type of fund. We leave the land of mutual funds to talk about indexed funds. What's an index fund? A type of mutual fund. It is also a mutual fund, but it's a type of fund with a portfolio constructed to match or track the components of some other broader market index. What's a market index? Well, here's some examples. The Standard & Poor's 500, sometimes called the S&P 500, or the Dow Jones Industrial Average, or the Vanguard 3500, or the NASDAQ, right? These are basically collections of companies that are tracked as an index to show, well, how is the broader market performing? And so if you, for instance, invested in an S&P 500 fund, that fund would be built of the 500 largest companies in the U.S. stock market to mimic or duplicate the S&P 500, how the S&P 500 performs over time. And so as you can see here, it has relatively passive management. It's not nearly as active management as a typical mutual fund because all the manager has to do is, well, make sure that it's essentially the components are weighted to duplicate the S&P 500. As a result, because the management is far less active, index funds charge significantly lower fees. And therefore, because there's lower fees, and quite frankly, the management doesn't have to be as active, index funds historically deliver better performance than actively managed mutual funds. Now, that also means that index funds provide you exposure to the broad stock market, which could be a really good thing or not such a good thing when the market isn't performing very well, right? So you are a little closer to actual market, broad stock market performance. Whether that's a good thing or bad thing depends, of course, on what's going on in the stock market, right? But they do charge lower fees, and over time, over the long haul, index funds will outperform actively managed mutual funds, all right? Now, from here, we get to another type of animal. That's the second fund. Now, the third type of fund is the exchange traded fund. What is exchange traded fund? An exchange traded fund is somewhat like an indexed fund in that it's a mutual fund, it has passive management, but the major difference is that an exchange traded fund is traded on an exchange like NASDAQ or the New York Stock Exchange, and therefore the trading is done, the buying and selling is performed between individual investors, not between me and the fund owner. Therefore, trades can happen all along throughout the day, prices change all along throughout the day, and that offers you what? Greater liquidity with the lower funds and passive management of an indexed fund. ETFs generally have become the darling of market diversification funds, and a much easier and less expensive way to have portfolio diversification in a fund. It still tracks an index, and so you get the performance of the index, but you also get the liquidity of exchange traded vehicles. So hopefully that makes sense. It is a different flavor of an indexed fund in one way of thinking about it, right, to deliver greater advantages to the average investor. Now, we've talked quickly then about mutual funds, about indexed funds and exchange traded funds, but really whatever option you choose, what we really want you to think about is make sure you are minimizing costs. Remember that little graphic of how much a 1% in expense ratio can make a difference in your overall return. Make sure as an investor that you are well diversified and that even the funds that you think about are well diversified. And remember, you are generally going to be investing for the long term. And therefore, don't just look at short-term performance of a fund, look at the long-term performance as a vehicle to grow your nest egg, your investment money. All righty. I hope this has all been helpful. And if you are new to this whole world of investing, holy smokes, this is a big mouthful of stuff to deal with, right? Perhaps this whole discussion in Module 9 has simply opened up a whole new world of questions for you. And that's a great thing. Again, we're not looking in this module to be able to answer every single question about investments. That's impossible to do in one module, right? But if it has opened up a whole new world of questions for you, really that's a great thing, right? And more in the textbook about answering some of these questions you may have. And there's great reading and resources to be done about how to select great investments, how to diversify your portfolio, what should be the role of different funds or individual equities in your investment life. But hopefully this has opened up a whole new set of considerations for you when you think about, well, how do I accomplish my long-term future investment goals? So I hope this has been helpful for you. I hope this has been a rich and enlightening module for you when you think about your investment future. So we'll see you in then the next module.